Is the microphone on? Yeah, now it's on. So ladies and gentlemen, I would like to welcome you back to the panel because we won't be too late for lunch. That's the reason why we should start in time. And this panel, the following panel, is on the geopolitics of energy or energy transition and climate change. And well, let me briefly introduce into the topic. We have seen that the Russian war in Ukraine has led to an energy supply crisis in the global economy, but especially in Europe, and even more especially in Germany, where we have heavily relied on gas from Russia, cheap gas from Russia. And at the same time, the COP27 some days ago has shown that, of course, the climate crisis has a huge geopolitical impact on the global economy. And all three, geopolitics, energy transition, and the climate crisis, form, I would say, a triangle within policymakers and governments need to deal with. And how this can be done, we want to discuss on this panel. And just to give you an idea of the procedure, we will start with some introductory statements with the four panelists. Then I have several questions, and eventually we are going to open for some questions to the audience. So let me first introduce the first speaker, that is Raekwon Chung. He is a board member of the Ban Ki-moon Foundation for Better Future. Thanks for joining us today, Mr. Chung, and the floor is yours.
Okay. Is this on? Yeah, okay. Yeah, good morning. First of all, thank you, Marc, for inviting me for this excellent, wonderful panel. And we just heard in the opening panel by the central bankers that our economy is on fire. Inflation, growth, and unemployment, all these issues. But at the same time, our planet is on fire too. So the challenge is, can we solve these two fires at the same time? Can you put out those two fires at one go? How can you do that? I think that will be the very interesting topic. Maybe I'll try to come up with the three challenges we are facing right now for this issue. First of all, the key question is, as the topic says, the energy and climate. Then between the energy and climate, can you have a win-win synergy between energy and climate? Maybe it's because of the Ukraine situation, the price of fossil fuel is rising. And can it open up the opportunity for renewable energy to catch up for price parity in many parts of the world? For example, in Korea, the price of renewable energy is twice the price of fossil fuel because our land is so limited. And so the price of renewable energy, can it be competitive because of the current energy supply situation? The second issue is the global climate regime, which is called so-called NDC, Nationally Determined Contribution from Paris Climate Agreement. We have seen so many target setting exercise, just like Net Zero 2050 we are doing now. All countries have come up with a political statement for net zero. How reliable are they? We did it in 1992 when I was a negotiator for UNFCCC. At that time, developed country ratified and agreed to cut their emission by the 1990 level by year 2000. But we already forgot about it. And in Kyoto Protocol in 1997, we agreed to cut 6 point something by 2012. But it was ratified by most of the country except just one country. But it was ignored, once again, even after ratification, the legal instrument. But now we did a similar exercise in 2009 at the Copenhagen. And then many countries at that time made the pledges, just like Net Zero 2050, for 2020, which is already 2 years past. Do anybody even remember how much number we have pledged in 2009 in Copenhagen? So this is the kind of failures we have been repeatedly fooling ourselves. Then how can we? What was the main reason why the NDC or target setting was not successful? I think by this time, after so many repeated failures, I think it's time for us to reflect on what went wrong, I'd like to, my idea is that my own analysis is that, first, we put the responsibility mainly on the government and on the business and on production, which is quite difficult politically because GDP is very, very important economic indicator. No government will be willing to reduce GDP in favor of climate. So this focusing on production, business, and government overlooked the role of consumption and the consumers. And all the consumers around the world are looking at government and business, thinking that what are they doing? As if they are the bystanders. In fact, the consumers are the ones who are responsible for their own reduction of emission. So even the current NDC structure is based on production emission. We have to distinguish from consumption emission and production emission. What I mean by consumption emission, you might know that, for example, my friend Romani from UK. Then UK is importing a lot of manufactured goods from China. And UK has a structural industrial restructuring, so the UK's production emission reduced about 40% since 1990. But if you calculate on importing of the manufactured goods, it is only about 16% reduction. So this is not the carbon reduction from European Union, rather it is a carbon leakage from Europe to Asia, especially mainly to China and Korea. So it can be an ideal topic for the dialogue over the continent, between the European continent and the Asian continent. The carbon has been moved from Europe to Asia, but it is not, at the global perspective, it was not a net reduction. It was simply a carbon leakage. So can we continue on this kind of production-based formula, or shall we move on to consumption emission-based global target setting? United States or many other developed countries, consumption emission is higher than production emission. And we are looking at China as if China is the culprit and the rascal of carbon emission. But they are doing the service for the developed country. So they are not consuming all those manufactured goods. So if we continue to focus on production emission, it will be placing very difficult political responsibility on the government who are dealing with the GDP, like the central banker. They don't want it to reduce GDP. So it will be quite difficult to reduce production-based emission. Then here, I would like to come up with another idea that we should come up with a PDC, not only just NDC. I don't have to repeat, nationally determined contribution. But these days I'm emphasizing personally determined contribution. Because if all the consumers are not accepting the burden and sharing the cost of energy transition, government and business if they are the only one who have to absorb the cost, I don't think it will fly very well. It will be very difficult. Then the consumers has to be a driver of this process. During last 3 decades of climate exercise, consumer was left out in our exercise of pushing the climate agenda. Now I think we have to bring back the consumer, not back, but bring up the consumers at the central stage of our climate strategy. So I call it personally determined contribution. If the person, and then in Korea we have a very interesting survey, 48% of the Koreans are willing to pay higher price for electricity, while 45% no. So my idea is that why don't we start with the 48% so that we can have a differentiated price for electricity? Why should we have only one fixed price for electricity? For those people who are willing to pay higher price to pay for the green electricity, let them pay for it. So I think this kind of new approach of providing options for the people who are concerned about climate change should be able to pay for different price. We don't have to because we cannot wait until social consensus is reached for one price. So this is what I call PDC. And then the third point I would like to emphasize is that can we have a synergy between short-term productivity and long-term sustainability? Short-term productivity means GDP. At the moment, we are talking about maximizing GDP, reviving our global recession. But in the long run, we also have to worry about long-term climate sustainability. Can it go hand in hand together? So at the moment, in the free market system, where the market price is not internalizing the cost of carbon, then without internalizing the price of carbon in our market price, can we have a long-term sustainability? It's not. So then we have to admit this fact. So now we have to think about not just a policy resilience or policy responses, but we have to also think about how we redesign our economic system and economic structure. For example, can central bank think about long-term sustainability as their mandate? As we heard in the opening session, the number one priority and mandate of central bank is inflation, interest rate, growth, but why not sustainability? Why don't we mandate central bank to be a driver of a long-term sustainability? And I had the Budapest Forum in September. I was there, and this is a very interesting discussion paper written by governor of the Central Bank of Hungary, of György Matolcsi. He is the governor. This topic is new sustainable economics. He is a central banker, and I was very surprised. Central banker is arguing long-term sustainability should be the top priority of central bank. So I was very interested, and I was very surprised. So now my point is, we need to restructure our conventional knowledge of a free market system. I hope it could be a sustainable market system with a sustainable price, not just free market price, because free market price means that it is externalizing carbon and water and the climate as externality. We can no longer treat them as externality. We have to internalize them. So the issue is, how can we do that? Is it politically, socially feasible? So what I'm arguing is that why don't we start with some people who are willing to support 48%, for example, in Korea. Many friends around me, they are all supporting my idea that I am willing to pay higher price for electricity. So let's start with this kind of new ideas of new approaches. So now I'm arguing that the conventional economics knowledge based on free market system treating climate as externality, I don't think we can have a long-term sustainability. So in the long run, of course, at the moment, we have our economy is on fire. So we have to worry about putting off the fire on economy. But we have to, at the same time, we shouldn't forget about our planet is on fire as well. So then we have to, in the long run, we have to think about how to internalize a carbon price into our economic system. Then it is, I know that it is not easy. I think it's very huge task. But we shouldn't forget about it, and we should try for it. And one of my suggestions is that we can push for new climate economics. This is why I promoted the idea of green economic growth. Green economic growth means short-term productivity can be a driver of long-term climate sustainability. So I promoted this green growth paradigm and, in 2005. In Seoul, we have a Global Green Growth Institute. And the World Bank, OECD is now promoting global green growth knowledge platform. So these are the kind of new attempts to come up with new knowledge, redesign our economic knowledge and economic structure and system. Thank you.
Thank you. Thank you very much, Mr. Chung. And our next distinguished speaker is Otilia Dhand. She is Managing Director of Teneo. Thanks for joining us today, and the floor is yours.
Thank you so much. I'm a historian by training, and political risk forecaster, and corporate strategy advisor. So I'll probably wear my different hats at various points while I speak. But first of all, I would like to emphasize what Mr. Chung just said, the role of the consumer. And this is also a sort of the underlining consideration of my remarks, because what I'm going to tell you is that it is my belief that in the coming years, we are going to see a energy overhaul that is nothing less than a reinvention of global energy supply chains. And within that lies both the opportunity and the challenge that will play out on the background of geopolitics. Let me start with stating the obvious. I sit in Brussels on a normal day, and over the past 18 months, European discussion on energy policy has been reframed significantly. If 18 months ago, in summer 2021, we have been considering energy policy as primarily an environmental question, by October 2021, there was the first communication from the European Commission on tackling rising energy prices linked to the post-pandemic recovery. Then fast forward to February, and Russia's open invasion of Ukraine, Russia being the primary energy supplier to Europe, and that again reframed the whole energy policy debate in terms of physical and economic security, because what we're facing right now effectively puts into question the well-being of European companies and the European society. And it is this security framework in which energy is going to be discussed for the foreseeable future. In Europe, we have three fundamental things to figure out. That is security of supply of fossil fuels, but particularly natural gas, on which we depend in the short term, investment into whatever we need for the renewable energy for the future, and then the third one, and that is to stand up to our commitments for the global just transition. Now, when I asked around in Brussels last week what people thought, the general assessment was, well, we don't have enough money. That may very well be true, we never have enough money, but we may be facing a more fundamental question than just distribution of limited funds. And that is that we are going to face a transition to a different way of consuming energy that comes from different sources and different suppliers. That really means that in the short term, Europe needs to address its gas shortfall, but it is through a combination of reduction in consumption as well as search for alternative suppliers. Now, next year is probably going to be the most pronounced in the focus on redressing the shortfall of gas, as Europe will race to replenish gas storage ahead of the next winter without Russian gas. That is inevitably going to have negative impact on the less well-off countries that are competing in essentially the same market. And Europe will have to grow its current relationships and forge new relationships with alternative suppliers, the United States, North Africa, the Gulf states, Central Asia, trying to address these new supplies. And in the meantime, we have European businesses working to fulfill their decarbonization targets and deliver the infrastructure that we need for the renewable future. Now, for that, they need equipment and they need raw materials. And both of these primarily come from abroad. We are also going to need more of them. By 2050, Europe is going to need 50 times more lithium than currently, 15 times more cobalt, 3.5 times more nickel. And what we see right now in Brussels is a very energetic discussion on how do we do that. European Commission is looking to new free trade agreements, to recycling, and to mining both at home and in the nearby friendly jurisdictions in order to supply raw materials. There is also a lot of considerations going into industrial policies for supporting strategic industries, particularly, let's say, electric vehicles, batteries production. And we have to avoid dependencies that have negative impact on our resilience. We're currently facing negative consequences of energy dependency on Russia. Now look at the renewables. 90% of solar panels that were imported into the European Union as of June 2022 came from China. China also dominates the supply of rare earth materials and in many ways refining of cobalt. Now, to avoid this kind of dependencies, the EU is going to look to diversify its supply chains, both for materials and for the energy itself. Expect the new projects in Europe, particularly offshore wind. We already have planning for a number of projects that will come online by the end of 2020s. That is in the North Sea, in the Irish Sea, in the Channel, in the Baltics. The UK is already the largest offshore wind market. And it has further potential. You know, the UK may very well be one of the future suppliers of energy to the EU. There are also in the Mediterranean the solar projects, but more will have to come from abroad in order to help Europe to create that future sustainable growth that we all imagine. And within that, for me, lies the opportunity for equitable clean growth. Because we're already looking at the resources, particularly in Latin America, Chilean lithium, Peruvian copper, but particularly in Africa. It is the Democratic Republic of Congo that produces 70% of world's cobalt. Lots of sub-Saharan African countries have deposits of rare earth elements. And North Africa is already a supplier of gas to Europe and may very well be a future supplier of solar and wind energy, potentially even hydrogen. Europe does have frameworks, partnerships, and sustainable practices and labor standards to help encourage growth that both supplies the resources that the EU needs and the economic growth that the developing countries are seeking. I would probably stop here because I like to end on a positive note. But there is one thing in the back of my mind, and that is that we shouldn't underestimate that we essentially have a very cold and dark winter ahead of us before we all burn in climate change hell. But to me, this could also be our finest hour when the sense of urgency helps us to step up to an opportunity, to a challenge that would otherwise be insurmountable.
Thank you very much, Mrs. Dhand. And next speaker is Mattia Romani. He is partner with Systemiq Earth. Thanks for joining us today, and the floor is yours.
Thank you very much, Henning. I think I've gone a bit old school, so I have some slides. I apologize. I was so excited about being in a post-pandemic world that I couldn't resist bringing the slides to a conference. But I promise I'll only show 3 or maybe 4. All right, at least I'll try if they come up. Thank you. Just an introduction. Systemiq, if you don't know it, it's a system change company. We do advisory, coalition building. The Energy Transition Commission is an example, and investment in the climate and sustainability space. What I want to focus on is climate finance and the challenge of meeting the climate finance targets that we set for ourselves, particularly for emerging and developing countries, in the adverse macroeconomic environment we find ourselves in. So this comes, I think, in a timely manner after the first session on macro. So Ambassador Chung very effectively laid out some of the challenges. We know the climate crisis is accelerating. Scientists are telling us that now delaying is dangerous. And to put it in Jacob's words, it's not a choice anymore. It's literally a non-correctable mistake that we simply cannot make, not taking action on climate. But we also have learned that acting on climate is not anymore just about costs and opportunities. We understand now that acting on climate is really about investments. I don't think anybody can any longer talk about the additional cost of climate action. This is really about the investments into building and rebuilding our economies in the next decades. So in a way, you know, a few years ago there was this debate, is development and climate action different? And I think we've come to the very clear conclusion that development and climate action are really one and the same. They're the same thing. I think we're increasingly realizing that productivity and growth and climate action are also exactly the same thing. They're not two distinct concepts, just because there is no other choice really. But in the midst of this, we are not advancing on climate finance quickly enough, particularly for emerging and developing countries. I think the commitment of 100 billion made in Copenhagen at COP15, Ambassador Chung was mentioning it. We know this remains undelivered. We also know that in particular when it comes to bilateral flows of grants, this is badly undelivered, as it became very clear in Sharm el-Sheikh. We also heard earlier the number 1 trillion. The world needs to mobilize 1 trillion in external finance by 2030 for emerging and developing countries. This comes from the Stern-Songwe report, which was commissioned for this COP. We were part of writing some of this report, and a lot of what I'll say will come from that report. But it's an important number to remember. This is external finance, which is additional to the domestic finance that emerging and developing countries can raise domestically. This is simply the external finance that is additional to that, and it's 1 trillion a year by 2030. That's the size of the need. So that's a little bit the sort of the background. I'm going to not talk about everything that is in the Stand Songway. You can read the report. It's online. It's a great report. I want to focus on three things. I want to talk about debt and liquidity situation and how this is impacting the ability to raise money to emerging and developing countries for climate. Then I'm going to talk about the role of private finance. And then I'm going to discuss an idea of how we could potentially meet the need for additional grants on the back of the loss and damage agreement that was reached in Sharm. So let me start with debt and liquidity situation. This chart will not be a surprise to anyone here. Here you have on the vertical axis the credit rating score and how it changed between 2019 December and 2022 October in emerging and developing countries. Well, I think it's a fairly clear chart. It got worse. And the reason why I want to show this is to emphasize how emerging and developing countries are going to find it very, very hard to raise money. And we talked earlier, it was very helpful actually, the previous session, because I don't need to say as much, but we talked about liquidity mismatches being an issue. We talked about debt overhang being an issue for emerging and developing countries. And by the way, these two issues are issues in specific developing and emerging countries. But I want to talk about the third issue, which I think is quite interesting, which is the debt instead of insurance issue that many developing and emerging countries are facing when hit by a natural disaster. When countries are hit by a natural disaster these days, they get additional debt. This makes no sense because you can't pile up debt on a country that has just lost productive assets. They're less likely to be able to restitute that debt. They're not more likely to be able to restitute that debt. That is a fundamental mistake in not following a polluter pays principle. Because the damages caused in these countries are not caused by themselves. They're caused by the pollution, the emissions of developed countries. So issuing debt to support them in that moment is simply not right. So there's many other issues with that. I don't want to go into the details of it, but it's clear that we need to rethink a little bit that instrument, particularly as this chart shows. Liquidity is harder to manage for emerging and developing countries as multilaterals, which are slightly easier to manage when it comes to debt, today account for about half of the external debt service, at least of middle-income countries. The way in which you read this chart, I'm sorry, it's a bit confusing, but if you follow that orange line and the axis for that is on the left-hand side, you see that between 2000 and now, the amount of multilateral debt service has halved. So that means that the greatest majority of that debt is actually with private parties, and it's much more difficult to manage for countries. So countries find themselves in a difficult moment. There is a recipe to fix this, and of course it goes through expanding access to low-cost official liquidity facility and low-cost finance. We've seen the IMF has helped on that. Debt suspension clauses in loan contracts in case of natural disasters are another thing that is being pioneered by Barbados and considered. And of course, considering climate vulnerability when issuing concessional finance is also a way to handle these issues. We also been talking about, this is the list of potential recipe in the Stern Songway report that we examined there, expanding of using debt for climate to nature swaps. There's a number of these initiatives which have started, and we need to urgently accelerate them if we want public debt not to be an obstacle over the next few years for climate action in developing and emerging countries. So that's for that. Let me then turn to the issue of private flows. I said that it's about $1 trillion a year, which is needed in external flows, both public and private. But if you take the entirety of the need in emerging and developing countries, about $1 trillion again is needed from the private sector, because as we know, the greatest majority of investment is needed, as we heard in the previous session, for high upfront capex investment. These are investments that require upfront capital, such as wind, solar, batteries, EV and EV charging system, hydrogen electrolyzers. These are very high capital intensive investments. So we calculate that about 70% of all the investment needs will need to come from the private sector. And we know this is going to be particularly hard because of the issues that we raised earlier for emerging and developing countries to raise. But this is not only for interest rate and inflation reasons, but also because of the perceived risks of investing in emerging and developing countries. So in the report, we'll go through some of this, but we also notice, and this is quite important, that investors are still searching for productivity-enhancing long-term opportunities for growth. And this is evidenced, I would just take 2 points of evidence. One, issuance of green bonds in emerging and developing countries continues to increase over and over. Last year, it doubled compared to the year before. We are now to about 100 billion a year issued in green bonds. This is still a small amount compared to developed, rich economies, but nonetheless, this is doubling every year now for a few years. So there's obviously interest for that. And of course, we know the GFANZ, like it or not, with all the issues it faces, is now an alliance that represents multiple trillions of dollars of assets. About 50% of global private finance is represented by GFANZ, and the state started making commitments around that. So there is an interest in investments from the private sector. So we identify a number of risks for the private sector that are piling up and making it more difficult for the private sector to invest in emerging and developing countries. So these impediments, of course, have to do with the investment climate. Here, I just want to be specific. This basically means offset risk in emerging and developing countries, i.e. the risk of utilities to be able to pay off a debt because they collect sufficient fees from their users. This is a big issue. Exchange rate risk is predominant across project cycles. There's an issue of asymmetric information of risks in emerging countries. Investors often simply cannot see what kind of risk they face. There's not enough data. There's a weak pipeline, not enough projects. The scale of some of this project is too small. There's not enough risk mitigation instruments. And we always face an issue of mobilizations at the moment. MDBs in particular face counterproductive incentives to support finance in countries. What does this mean? Well, the results of this piling of risks is exemplified by this table. This table gives you the equity return expectations for solar PV projects in a number of emerging and developing countries. So these are equity returns expectations. You can see that they go from 7% in Germany to over 50% equity expectations for solar PV in a country like Argentina. So the point I want to make with this table is the risks I just took you through. It's just a list, but the results of those risks is drastically different cost of capital for emerging markets compared to developed countries. So there's a real issue that we need to sort out here urgently if we want private sector money at scale to go to developing and emerging countries. I'm going to go to my last point because I'm speaking too long. I apologize for that. And you can go into the Stern Song web paper. We have a series of suggestions of what can be done to resolve some of these issues. But I want to move to my last point, which is a point about the loss and damages fund that has been announced and shared. We know that there will be a continued need for grants. Part of the reason is that resolving some of these issues, i.e. the issues of cost of capital in emerging and developing countries, will still require some element of grant finance for specific risk management instruments and blended finance solutions, such as first loss or an exchange rate risk management facility, and so on. So it's very clear that, and in even the G7 at Carbis Bay made it clear that we need about double the amount of grants from today by 2025 to leverage and support private finance to go to emerging and developing countries. So one of the ideas that can be considered is based on this. This chart gives you the actual and forecast profits from fossil fuel companies in 2022 on the back of the higher energy prices caused by the war, because this is the main reason why fossil fuel producers are experiencing exceptional profits. So as you can see from this chart, the dark gray bars represent the profits last year, 2021. The dark red, the actual profits reported up to Q3 this year. So you can compare the gray last year with the dark red, which is this year. And as you can see, profits this year have been more than double profits of last year, and they were completely unexpected. They weren't driven by the hard work of these companies. They were more like a winning at a casino, or if you want to be less gentle, a winning at the casino where the lucky outcome was driven by war. One idea in the moment in which we so urgently need stronger grant flows to emerging and developing countries in the context of the loss and damage commitment made in Sharm, one of the ideas, given that rich countries' track record on delivering such grants has been so poor, as Ambassador Chung was pointing out earlier, is for fossil fuel producers to play a leading role in kicking off such a start. We calculate that the chart that you see here, plus national oil companies, mean that profits of the 10 biggest fossil fuel producers in the world will exceed 400 billion this year, about 200 billion more than they expected. Just to give you some flavor, ExxonMobil recorded profits in Q3 2022, just these 3 months, of $18.7 billion. This is triple what they had made last year, and the highest quarter in 152 years of history of ExxonMobil. To use President Joe Biden's word, companies are making profits so high, it's hard to believe. So it seems to me that kicking off the loss and damage fund with some funds from fossil fuel companies could lead the way for others to follow suit. And this seems to me a particularly timely opportunity, given next COP meeting will be in the UAE, which is a region that more than others has benefited from these profits. Let me stop here.
Thank you very much, Mattia. And next is Miriam Leuschner. She is Chief Advisor to the Vice Chair for Energy, Climate and the Economy of the Parliamentary FDP, that's the Free Democrats at Deutscher Bundestag, and she's very much engaged with passing the energy legislation currently. So we are very glad that you came to Paris, and please, the floor is yours.
It's already on? Yeah. Perfect. So thank you very much for having me. I'm going to try and provide a little bit of a maybe policymaker perspective, focused on the specific case of Germany, because Germany, I guess, is exemplary within the EU of bearing a bit of the brunt of the current energy crisis. But before getting into this, into more detail, we've heard a lot about different crises today, and I guess in order to see how you deal with them, a good way is to look at what constitutes the different crises. We talked about energy in particular, we talked about climate change, and I guess it's quite important also to keep in mind that COVID was a foreseeable crisis with an end to it. So from a policy perspective, I guess it was not questionable to intervene. The states had to intervene and take some of the brunt and some of the weight of the effects it had on people, because it put restrictions on. I guess there's a difference, though, that I perceive between the energy security crisis that we're facing at the moment, which is very short term. In Germany, we're currently talking about this winter in particular. Even though it's going better than we hoped, the gas reserves are filled much higher than we initially feared would be the case. But we are looking at a time frame of about 2 years for markets to shift, for new partners to be found, and to basically move away from the shift that we're having at the moment, to then the climate crisis, which is a long-term and probably one of the biggest challenges that we're going to face in the 21st century. So keeping in mind that there's a temporal difference, I think when we discuss the trade-off, or what seemingly is often addressed as a trade-off between the energy security question and climate change, I don't think there necessarily there is a dichotomy here. It's more processes that are running in parallel, and we need to be very aware that the current situation is very acute, and it's very acutely felt in Germany. It's very acutely felt because we go into rooms that are cold, because there is a real possibility that certain households will not be able to to bear the financial burden of the costs that we're seeing. So this, again, is a reason for the government to step in. However, for fossil fuels in general, from a policy perspective, I think it's important to signal that they have a realistic shelf life. Germany has gone about this in a very specific way. In the early 2000s, in 2002, we put an end to coal, decided the exit to be by 2038, and in 2011, following the Fukushima incident, Germany decided to exit nuclear energy. Now, currently, we're having a discussion to bring both back. So, from an economic standpoint, there is obviously no question of going back into nuclear, but we have, this has come with significant economic and financial loss because we have paid companies to basically take something off the market that now we're finding we need to bring back in order to see us through the current crisis. So from, I guess, a climate point of view as well, the International Economic Energy Agency is assuming that there will be a peak of fossil fuels around 2030 that we will need to see as part of the transition. And I guess gas has a particular role to play in that because of the future potential that it holds for hydrogen production, for example. And if we want to get to a future where we have hydrogen available to us, we need to be aware that this is a long-term goal. This is not something that can be achieved overnight, and that we need to work towards it. Nonetheless, I think focusing back on the current situation, Germany, I would say, is more acutely felt as at the receiving end of an economic war that is being fought on energy policy. And I guess that is a particular shift in the geopolitical landscape that you can call it, we always talk about the war in Ukraine, but effectively the driver of the interventions from Russia on the German energy markets is to destabilize the economy. It's to instill a certain, fear in society and in politics, and playing on that. So I would say, yeah, it's very much an economic sort of war. And what we've learned from that is, I guess, that Germany has relied on a business model of cheap, reliable Russian gas for the past decades, and we all know that that model is over. In whatever way, it was mentioned earlier in the earlier panel already, whatever we go back to, it will not be the model that we had, because it was not sustainable, and we saw the effects that it could have. Also, getting out of this situation will not be done overnight. We need time. Infrastructure gas pipelines are laid the way they're laid. You can't move them overnight. So it will take, as I mentioned before, we're looking at this winter, we're hoping to find ways to get through the next. It's something that won't be done instantaneously. But it has also put into perspective the dependency of European nations, and Germany in particular, and the way it interacts with its international partners in particular. There are two ways, I guess, that from a policy perspective we can act on this. We have homework to do, I guess, on a national scale. If you look, you mentioned investments. One part is obviously making money available in order for private businesses to come in and actually make some of the change. But if you look at bureaucratic hurdles, Germany at the moment, in order to plan a railway, just the planning process, it takes about 18 years. You haven't built anything by this point. You've just thought about the railway, you've thought about the idea of putting it out there, you've gone through the bureaucratic hurdles, but you haven't put down anything. There's nothing concrete at the end of it. So if we're looking at funneling and channeling investments, we need to also think about the framework in which the investments can be made. And I guess that's somewhat of the homework that we have to do in Germany. This year in particular, the current government passed legislation on accelerating the process of building LNG terminals. In a way, I guess you mentioned it earlier, to finish on a positive note, but to really put out there, like the legislation that we passed, basically within 6 months, the planning permission for these terminals was ready, and we're going to see at the beginning of 2023 the first LNG terminal that has come out of that legislation. So comparing this to the 18 years of the railways, we need to do our internal homework, but also the business model that I mentioned, relying on Russian gas, and having an exposure, much like a business. You look at your assets, you look at your business model, you look at where you have certain risks, and I guess a lot of people are currently inclined to say that globalization has failed, that the way we're doing business internationally has failed. And I would argue that really, in the case of Germany at least, we've never really reached the full potential of globalization, because all we did, we outsourced different needs bilaterally to different countries. We outsourced the need for security to the US. We outsourced the need or our needs for energy very heavily to Russia. Over 50% of German gas came from Russia previous to the Russian invasion of Ukraine. Finally, we outsourced our need for growth to China. So this is not a model of globalization where we have a multitude of partners acting in their own different interests and getting something positive out of it. This is not a diversification strategy. This is very much a vulnerability based on very bilateral partnerships. So what I guess we need to do is very much sit down also as Europeans and see where our vulnerabilities lie, look at where we can shift to something that is also more sustainable in that sense, because I don't think that we're going to gain anything by retracting now and making sure that everybody's going to be self-reliant, because the geographical position, for example, of Germany doesn't mean that we have a lot of hydropower available, or that we have geothermal or something that other countries may have, and this will be the case for a lot of countries. So I guess to maybe finish on this, I think there is a real need to become more emancipated in the way we address foreign trade partners, or in the way we act on the international stage. The Inflation Reduction Act was just passed in the US and hailed as a particular step forward. However, it has specific provisions that exclude European businesses specifically from investing in a very growing, very active market, which is causing concerns. And obviously for Europeans, that should be something we should be more outspoken about. The same thing goes for specific decisions made by China, the Belt and Road Initiative, you all probably know about it, and things that we mentioned before, considering us as Europeans to also ensure that we have more sustainable ways to sourcing critical raw materials that we need and that the businesses that we have rely on, and that are the foundation in a way, steel, ammonia, whatever, that will help us transition to a more sustainable economy. Because without the raw materials, all the wind parks won't be built, the technology that we need in different areas won't be erected. So yeah, I think we need to become a bit more emancipated on that. Thank you.
Thank you very much to all panelists. And before opening up the panel for a Q&A, I would like to ask another question to all four panelists. I mean, putting together what we have heard in the first panel and also what we heard in the second panel, will geopolitical fragmentation or even forms of deglobalization negatively impact or even put a brake on energy transition and climate action? Or is it the other way around, that new forms of cooperation and globalization may emerge from leading climate action and pioneering energy transition? Mr. Chung, what is your idea looking, forward to the year 2025 or so, around that? Because I do know that it is a matter of different time horizons, isn't it?
I don't want to come up with pessimistic or negative messages, but what has been happening so far during last 3 decades, and it was not very encouraging. Our 3 decades of experience was not very encouraging, and also because of the current geopolitical issues, and for the future, I think now the tendency of each country only going for each country first attitude, like America first. Everybody thinking they are first, then they are going for himself. Everybody for himself, right? Is getting stronger and stronger. And so I think maybe the strongest these days, I think, is getting. So I'm not sure. It all depends on how we make our choice, political choice at the moment. But I hope that Europe, I think Europe should show the example, since we cannot expect some kind of a great leadership from another continent. So maybe Europe is the only continent that can show some kind of a leadership for such kind of a new form of a global collaboration. This is my wish, but I'm not quite sure whether that can really happen in view of the difficulties Germany and all these European countries are facing now. So we have to rise above extreme short-termism towards a little bit of a long-termism, even though we have to put fire on our economic house, but our planet is on fire as well. So it is all about rethinking our own self-interest. So thinking about others and thinking about the long term will be in my own self-interest. I think that is enlightened self-interest is getting more and more critical and crucial. Thank you.
Otilia.
Thank
Please.
you. I will probably divide it into 2 parts, the sort of the medium-term outlook and then the long-term outlook. In the medium term, as with any economic insecurity, you usually see people first protecting what they have and preference for their own industries, as Mr. Chung said. We see that in the Inflation Reduction Act in the United States. We see that in the consideration of industrial policies in Europe. The protecting what you have and making sure that you have things at home in case crisis hits is something that typically comes back at the time of the crisis. Also, nationalism usually comes back at the time of insecurity. That will almost necessarily motivate competition rather than open collaboration, which in theory should be the winning strategy for everyone. But again, I also have faith in Europe, primarily because we don't have much choice. We do not necessarily have enough of the resources that we need for our future sustainability without trading. EU is, in a sense, a trading and economic bloc to start with, and we need external trade to prosper. This is something that we should probably be looking out for. In the long term, perhaps the question is who is going to benefit, because the great dominant powers of the current system are not necessarily the future dominant powers. Have a look at where the powers of, let's say, 70 years ago are. The world at the beginning of the 20th century was dominated by the British Empire. So if you have a look at the long term, what we probably need to have a look at is where those future sources of energy are going to be that help that particular jurisdiction to build a strong economy, bringing it on the top of the pile in terms of geopolitical relations.
I have a slightly different opinion on some of this thing, just to make it a bit more fun. As I used to work for the European Bank for Reconstruction and Development, we used to tell our countries, you cannot have local content in your renewable projects. You cannot have locally produced panels, because that's not efficient. We want globalization and you want you to benefit from the cheapest panel that happen to come from China, because China invested in a long time, and you actually benefit from that by getting cheaper panels. I was always a bit doubtful of that approach. And part of the reason why I was doubtful is that I felt that in a world in which we were moving away from oligopolies of energy and energy was more accessible and diffused just by the nature of renewable energy, what you don't want is to create back these oligopolies around supply chains which are owned by few companies or controlled by few countries. So I felt that there was some logic for that. It's very challenging because, you know, I grew up and I studied economics when globalization was the thing to do to reduce cost and make it more efficient. But I start wondering whether we've got to be careful, at least for a while, not to recreate an oligopolistic system in the new renewable-based energy system. I have another point on CBAMs and climate clubs, but I'll leave it for later if it comes in questions.
Okay, thanks.
I guess I'm going to give a little bit more of a political answer to this. I definitely think that we all gain from cooperation, be it in trade, be it in international relations, because ultimately it's not just the business side of it where everybody stands to benefit if done right, and if you find the right partners. And I mentioned also the extreme dependencies that some of the European nations have put themselves into, really. But there's also values that we share and that cannot be detached really from doing business, let's say. I mean, there is an inherent, obviously there's an inherent value to freedom of speech and what have you, but there's also a business environment that comes from having a free market economy, from having businesses knowing that they can invest in a future where it's not, things aren't going to be taken away from them, their companies aren't going to be dissolved because of some political shifts. So the value side, I think, is quite important. And if we look at Europe in particular, we cannot afford to just think of ourselves. And I think we have done that a little bit too much in the past, focused on kind of a little bit more inward looking. If we look at energy costs in particular at the moment, or at least at the end of last year, Germany was looking at electricity costs of about 34-35 cents per kilowatt hour. Saudi Arabia and Qatar are producing at 3. That's about a tenth of the cost. If we believe that we can remain competitive and that we can protect our economies and shield them from these huge price differences by trying to outcompete such countries, I think we're going in a very, very wrong direction. So if we look at the fact that everybody has something to bring on to the table, I think we all benefit. And if you look at China, in terms of, we had the topic of sustainable finance earlier, there are now most of the major regional hubs in the world are looking to establish a framework for sustainable finance. We have the taxonomy process that's going on in Russia, it's going on in China, it's going on in the EU. So there is a drive, and there is really something that has shifted, and I think we should be a bit more positive about it.
Thank you very much. We have 10 more minutes for questions from the audience, and I think there was one request to make a comment, please.
Thank you very much. My name is Urban Rusnak. I was serving 10 years as the Secretary General of the International Energy Charter in Brussels. So I have 2 comments and 1 question. So first of all, I would like to join those voices which have been very much supportive, that be worried, do not create a new oligopolies, new monopolistic value chains. So I would like to remind all of us that the post-Cold War architecture in Europe was based on a very important idea of mutual interdependencies in energy with Russia, or with post-Soviet area. And we have seen that those interdependencies didn't work as good as we expected. That at least that they are not able to bridge the geopolitical ideological gap, if you wish. So, and having this in mind for the future, so we shouldn't enter the new arrangement with other partners where we may have a similar ideological or geopolitical gaps coming on, which are not visible yet, but it makes not too much sense to build up a new interdependencies, believing that, well, that mutual trade is beneficial for all of us, we will all benefit of it. Yes, until the point that the counterpart will decide, no, it doesn't work for the ideological purposes, and they will use this build-up interdependency against us. The first comment. Second comment is, I was very much looking into the slides displayed by Mr. Romani, so I like them very much. You have been pointing out to 2 or 3 important issues. First of all, that we don't have enough risk mitigation instruments which will allow and mitigate the risks across the board. You made a nice chart of the countries, how much the cost of capital is different for a single similar project, which is photovoltaic solar generation. So I would like to ask the panel. So first of all, I would like to make a comment on the fact that last week was the Ministerial Conference on Energy Charter, which actually didn't approve the modernization of this unique risk mitigation instrument we have inherited since 1994. We spent almost 5 years on modernizing it, and finally we get to the point when the modernization was rejected, was postponed, because European Union couldn't agree on a mandate for it. Basically, the face value of the argumentation goes that even the modernized energy charter is not good enough to meet the Paris Agreement, and is not good for the Green Deal in European Union. I completely disagree with this argumentation, because the facts do not support this argumentation. So there is, if Energy Charter Treaty was used for something, the last 15 years was for protecting renewable investments everywhere in Europe, indeed. If there is any serious amount of fossil investment in Europe, this is not covered by the Energy Charter Treaty. Most of those investments are local, domestic, or are coming from the parties, non-members of the ECT. So it doesn't stand that we need to remove, or to removal from the Energy Charter Treaty will help actually countries to meet the Paris Agreement goals. Further on, if they will withdraw from the treaty, what it means? That means that they will be locked for 20 years in a current legal regime, which they don't like at all, which dates back to 1994. So I lack completely the rationale on this discussion. May have seen it in a world media, and there is very little voices in favor of the Energy Charter Treaty. So I would like to ask panelists if you have any idea of this instrument. Maybe Mr. Chung doesn't have so much, because Korea is an observer to the Energy Charter process, not a member of it. But the other 3 panelists, they may have an opinion on this. Thank you very much.
Thank you very much. Because we are running out of time, I would like to suggest that we collect some couple of questions and we go back to the panel for some minutes. So I think there was one, Massimo here, and well, over there, maybe 3 or 4. We're running out of time, I'm sorry. Please.
Okay. Bernard Snoir from the Robert Triffin Association. Couldn't we learn more from the reaction of the international community and from Europe to the COVID crisis and make a little comparison? Do you think would be feasible at the European level to have something comparable to the EU Next Generation Fund, which creates solidarity among EU states? Not all of them have the same fiscal space. Not all of them are equally affected. Not all of them have the same level of investments to finance. At the world level, could we think to the solution? It took more than a year to the international community to come to it. SDR allocation, because I frankly don't see how the emerging and developing countries will finance their share of the huge investments that they have to make. They are over-indebted. A large part of their savings are, in a way, captured to create ever bigger foreign exchange reserves. So at some point, the international community will have to think about doing something similar. Thank you.
Thank you. It's Massimo De Andres from SRM in São Paulo. Talking about geopolitics, which is the key word of panel, I would like to ask speakers to focus their view a little bit on geopolitics of energy in the Mediterranean region. Because I think it's very difficult, and someone of you already said that, for Europe to reach decarbonization goals only investing and improving renewable production inside Europe. We also need to import, from the European perspective, I mean, to import renewables energy, and the question is from where? And the only option is from North African countries. You know, now technology let it possible what it was not possible just some years ago. For example, you can produce electricity with a solar plant or a wind plant, and to transform this electricity with power-to-gas technology into synthetic gas. Or you can start the ammonia process and the production of green hydrogen. So, and also, let's think about another point. When we talk about the classic energy cooperation between Europe and North Africa was, I pay Europe, I pay for oil and gas. I bring money to you in exchange of oil and gas. Now cooperation in renewables mean technological cooperation, mean manufacturing cooperation, because under a solar plant you have manufacturing production. You need raw materials cooperation. I mean, it's also an economic cooperation. It can be a win-win cooperation. Think about the impact on logistics in ports, for example. If we talk about ammonia, now we have ships transporting ammonia, which are like oil ships. So the question is why we don't stress more at the European level the point that we need cooperation, which is can be a win-win cooperation with North African countries and MENA region. Thank you.
Thank you very much. My name is Angela Kane, and I found this a fascinating panel. Thank you very much to the panelists. And I have two specific questions. The first one goes to Mattia and then to Otilia. You talked about the green bonds, and I think the green bonds are now kind of the new and shiny thing that everyone wants and everyone wants to issue. And if I'm correctly informed, I think it's about $500 billion that it now amounts to. And the European Union countries as a unit basically are the largest emitters. But the first emitter is the United States at 81 billion, and then China. And what worries me is that there is no agreed definition on what is a green bond. I think there's a lot of hype out there in terms of what it does and what it's achieving. And I know the European Union is doing some work on this. But on the other hand, what I also worry about is if the European Union agrees on whatever connotes a green bond, that does not mean it's going to translate to the United States, to China, to any other country. That's my first question to you, Mattia. The second question comes to Otilia, and I found it fascinating that you brought up the subject of the rare earth. We're talking about geopolitics, and I basically think that the European Union has missed the boat on that. China has wrapped up a lot of the rare earth materials that are already existing, particularly in Africa, etc. So my question is, what is the European Union doing about this? Because you hear very, very little about it. And the other thing is when it comes to the rare earth, this is really where productivity depends on in terms of what is possible in the economies of the European Union, which depend on those rare earths in order to basically produce. Thank you very much.
Can I, Lassina, Burkina Faso, let me say this, it's better. I want to thank you for an excellent panel, and then thank Angela for bringing part of my question. So we're talking about geopolitics of energy. And you talk about renewable energy. There's a lot of EU funding for Africa in renewable energy. But there's a big disconnect right now, and I think President of Senegal has mentioned it during one of the conferences, which is you're pushing for renewable energy, and Africa is discovering a lot of fossil fuel, okay? And then you're asking not to go there because of global warming. And no one in Europe is pushing for the technological development that we have in nuclear energy today. Let's not forget, Russia, in the past 10 years ago, they started memorandum of understanding with a lot of African countries to develop the small modular reactors. And now, with the difficulty that we have with Russia in terms of sanction, Africa will not be able to continue its agreement that they started with Russia. What is European Union doing for that? Bearing in mind that in the discussion concerning pathway to achieving net zero and global zero greenhouse emission, we shouldn't forget the developmental interests of Africa. That's my question to you. Thank you.
Thank you. Okay.
Jonathan Granoff,
Very
President.
brief, please. Just a minute, please. Please, go ahead.
Yeah. Jonathan Granoff, President of the Global Security Institute. Dr. Frankel pointed out that political processes are needed for structural changes, the structural changes to happen to be able to address climate change appropriately. In democracies, that cannot happen without truthful, accurate, and thorough reporting of the impact of investments, finance, and companies on the environment. So the question is how to bring environmental impact, climate risk, into the financial reporting requirements of central banks and ultimately into the equities and bond markets so that individual agency of consumers, which was so appropriately pointed out a moment ago, can be exercised. In other words, how can the consumers possibly, and investment consumers I'm talking about, possibly exercise their moral agency to move to address the climate unless there's accurate reporting in the bond and equity markets of the impact of Mobil, Exxon on the climate, for example. How to make just truth in economic reporting in the markets accurate, thorough, and truthful.
Thanks for the great questions, and I give you 1 more minute to address whatever question you like. Please, would you like to start?
Maybe I'm going to start with the last question. I mean, there's a multitude of initiatives that have started, and I guess I mentioned the EU taxonomy earlier on. It is not an easy undertaking. It is always a difficult political process, but you are right that in saying that the accuracy of information is something that is needed in order to make the right choices. But finding a common definition of sustainability, and whatever that entails, I mean, we've seen that the process on the social taxonomy at the EU level has come to a stop because really it is so vast a field that it's very difficult to nail down definitions on that. But yeah, the more information, the better, I would say. And maybe you mentioned earlier the question on the geopolitics of energy and the Mediterranean region in particular. It's an interesting point. I mean, there was I don't know if you're familiar with the DII initiative that was sported back about, I think it's about 10 years ago now, where specifically harnessing the solar power potential of the North African region was envisaged. But I think we need to think even further than that. There are various regions of the world that have the potential to provide new sources of energy, and we need to look everywhere outside of Europe. And yes, we will not, I'm convinced that for a country like Germany, we cannot hope to realistically fulfill all our energy needs within Germany itself, and I don't think it's a sensible approach. So yes, we need to look to international cooperation also, worldwide, basically.
Thank you. I'll go quickly on Mrs. Kane's question, and that's regarding the rare earths. The first time I had anything on rare earths in Brussels was maybe in March this year, which was already too late, right? And then like rare earth magnets, everybody had to Google what it is, right? And then we're looking at the sort of the chart of proven reserves around the world. And it's difficult to say how much of it is directly or indirectly controlled by China, but obviously they mine the largest share of the current production. But there are proven reserves in other places. And again, difficult to say who exactly controls it. But to me, the opportunities were probably in Latin America rather than anywhere else. It was Brazil that mines very little at the moment and still has substantial proven reserves. But right now, I don't yet see a coherent strategy on rare earth materials in Brussels right now. I think it will develop on the back of the discussion about critical raw materials, which will come early next year, but there is not enough of it yet, and as you said, we missed the boat. On modular reactors, I'm with you. EU should offer alternatives and funding for the alternatives for African countries. We see a bit of it in North African countries. There is a collaborative framework and partnerships and funding available that already, I believe there is a wind farm in Egypt and 2 solar under construction in Morocco, but that's not enough. You know, we have a lot more resources under the Global Gateway project and a number of other sources. In terms of the next generation, definitely discussion going on, but let's not forget we still have about 200 billion left in the current next generation program. That is in forms of loans, but it is still available and the countries can apply for it. It takes about 2 months to change your national program to apply for that money, and it's available. And finally, on Energy Charter, a huge missed opportunity. I already started wondering about how that one is going to go when in the run-up to the decision-making, countries started mumbling about you know, that not being good enough and not good enough for future. But with a number of changes that we have coming up in terms of emergency measures and then the long-term measures for the European energy markets next year, it may just be on the table sooner than we think.
I'll be quick, it's great, so I can only answer the easy questions. I don't have to answer them all. I really like Massimo's point about the opportunity for the MENA region and the Mediterranean. I think the combination of extremely cheap renewables in North Africa and high demand for decarbonization of industrial sector in particular in Europe means only one thing, which is hydrogen and ammonia. And the ammonia transition will happen through the shipping industry first because they'll need it for long distance fuel, but it's also an energy carrier and the key to the decarbonization of hard to abate sectors. And let me plug Systemiq and Energy Transition Commission work on this. If you want to have more information about that, go on the website, there's plenty on it. But it'd be a substantial opportunity. I think it's not fully understood, the extent and size of that opportunity for the Mediterranean and for shipping companies in particular, and the role they can play in accelerating. Great question, green bonds. We know we need better standards for green bonds. We don't have them. We don't have them in Europe. I mean, you know, it was in the news, HSBC's mess up of their green bonds that ended up financing fossil fuel investments. We're seeing this left, right, and center. There's an absolute urgency to do that, particularly, as I said, emerging markets are issuing more and more green bonds, and there's a perception of higher risk of these green bonds in emerging markets. I think if we had common standards, that perception of risk would go down, and that would benefit the flows into that area. The last question I loved about what kind of information do we need to make it into the market for, you know, the full signals of the risks associated with fossil fuels. I don't know, but I have one pointer, which is what happened to the coal industry in the market. The equity, you must have followed that the equity price of coal-related companies and indexes have plummeted in the last few years. In fact, must have been delisted. ETFs on coal have mostly been delisted by now. So if that is a signal of what may happen in the future, I would say let's watch for non-linearities in the asset valuation in this space. That what I would, if I was running a hedge fund, that's what I would be looking at. Thankfully, I'm not.
As I am the last speaker, I'll just emphasize one very crucial issue. The temptation to resort to maximizing the growth, short-term growth, is getting stronger and stronger. But just maximizing short-term growth at the expense of a long-term sustainability is something that we cannot afford anymore. So this is a very, whether it's a green bond or whether it's a super grid from North Africa, it is all competition, struggle between short-term and long-term. And we have to rise above and come up with this, try to come up with a strategy to synergize between short-term and the long-term. And how can you do that? It's something that we have to work out for our future. Thank you.
Thank you very much to the great panel, for the fantastic panel we had. And please remain seated. As a matter of time, we directly continue with the next panel. I'm sorry for running out of time.
Yeah. Thank you, Henning.
Thank you.
Thank you so much.
Very well managed.
Thank you.
Thank you.
Hi. Nice to meet you. Hi. Nice meeting you. Dominic, with Basilio, EBRD. Hi, Dominic. Nice to meet you. Here, right?
Well, yeah. Professionally, yes, but I'm living in Strasbourg, so coming in today.
How is it, the community?
It's okay. It's 1 hour 40 TGV, so it's okay. It's manageable.
Yeah, as long as you don't have to rely on airports and that's a big improvement.
Oh, no, even TGVs are always, yeah.
Okay, sorry for the delay. We are late, but I hope Alexander can join. He's trying to get home, but he has a problem with electricity. Okay, good morning.
For the slides, if I want to connect, how do I do?
Can you check with the technician over there to see the best way to do that?
Do a slide.
Il a des slides. Okay, good morning everyone, and let's start our next session, the global economic consequences of the war and rebuilding Ukraine. We have an outstanding panel. We are running a little late, so I will try to really introduce our speakers. We will have, hopefully, Alexander Rodnyansky, who is the president advisor of Mr. Zelensky, joining us online. He told me that he has some problem with internet, but I hope he can manage to be with us. But I asked him, in fact, to speak the last, because I think he wanted to hear what our speakers and panelists will say, and he can really comment and reflect on the proposal from the international community. So we're going to divide this panel in two parts. Moritz Schularick, who is a professor of economics at the University of Bonn and also at Sciences Po, will lay out the stage about the global economic consequences of the war, and also Dominic Rohner, who is also professor of political and institutional economics at HEC Lausanne. Then we will follow about what the international community can do for Ukraine. As you know, there have been a lot of similarities, and in fact, recently in Berlin, there was an international conference where Madame Ursula von der Leyen mentioned that what we are trying to do for Ukraine is more or less like the creation of the Marshall Plan for the 21st century. So we'll ask our two representatives from international institutions, Mr. Tomas Bocek, the Vice Governor of the Council of the European Development Bank, and I take this opportunity, Mr. Bocek, and your institutions, because you will be hosting us tonight, for your hospitality and for supporting our event today. Followed by, last but not least, Carlos and Basilio, the Managing Director of Corporate Strategy of EBRD, who have been long-term friends of the EBRD, and I'm very glad that you are with us and trying to provide us also what kind of country platform, donor platform would be needed for Ukraine, and I think you are involved in this. So without ado, why don't I start with Moritz. Moritz, over to you, and thank you for joining.
You wanted to start with Dominic? But I'm happy to start, but...
Dominic, things are okay? Yeah, Dominic, please, so go ahead. Okay.
That's fine.
We are among friends here, friendly sharing, so we can...
Okay, thanks a lot for inviting me here. I'm very happy to be here. So yeah, we have slides for me. Again, my apologies for... it's a PDF. Okay, super. Yes, so I'm going to talk about basically, to kick off a bit this discussion of the consequences of the conflict. I will start from talking about the e-book that we recently published. That's fantastic, thank you. That we recently published together with my co-editors Luis Garicano and Beatriz Weder Di Mauro. And so we focus basically, so CPR is this kind of academic think tank in Europe, and we have this debate page on Ukraine, where now we have approaching maybe almost 100 columns written by academic economists who would kind of cover an angle of the question. And we selected some of them and have put together this ebook. So it's open access, you can download it very easily, just put it in Google. So we cover things like sanctions, supply chains, and sustainability. Well, let me start with kind of stating the obvious, right? We shouldn't kind of start with purely economics, because we would forget about the really crucial point here, just the human suffering, right? I mean, let's just pause a moment and remind us what this means, this war, to human suffering. So 40,000 civilians killed, 15 to 30 million refugees, over 100,000 soldiers on both sides. And these are numbers from 10th of November, so they may be even higher in the meantime. But so that's the first thing we of course care most about, even being economists. Now then, when we look in this book at beyond the fatalities or the economic effect, I mean, maybe I'll just start with kind of giving you a frame of what we observe. Well, what you see is that basically Ukraine has a huge hole in the budget, right? They can cover just a budget, they have a monthly deficit of $5 billion US dollars. They just cover a third of the budget with regular revenue. 1/3 is kind of inflation tax, is central bank printing money. That's not really sustainable in the very long run. And 1/3 is for foreign help. So they have a massive problem, and of course they need our help, right? When it comes to looking at the impact on the civilian population, what you see is that at the very beginning of the war, consumption plummeted by half. So people would just consume half of before, and now it recovered a bit, but they still have a gap of consumption of 1/4, and it's one of the poorer countries in Europe to start with. So again, it's a very, very tough situation. So that's kind of just to the starting point to talk about the situation. Now, then in the book, what do we cover? In the book, what we talk about is the first 16 chapters of the book are about sanctions. Do sanctions work? Don't they work? When do they backfire? Well, you have you have to read the book to see all the details. I don't have time to cover all of it. But basically what you see is that some sanctions on high-tech products seem to have had the desired effect, while some sanctions, for example, on big banks or companies, there is some evidence that the Kremlin would kind of give support to sanction companies that could kind of mean that some of the effect is not very big. So that's kind of, and then it depends, of course, on the sector, etc. So I invite you to read the book. One very important question, very much linked to the last panel, is the question of energy sanctions. So we are kind of in a very, very tricky situation at the moment since the beginning of the war, where basically what happened is that markets anticipated tough sanctions on oil and gas, which let the prices explode. So gas and oil went up, and that's our colleague before showed this graph with, you know, the red bars were way bigger than the gray bars, so there was a huge excess profit of oil gas companies. And so these prices went up, and of course much of the money also flows to Moscow. So basically, at the end of the day, much of the salaries of the Russian soldiers are paid by consumers of fossil fuels in Europe, even if they're very pacifists, right? So clearly we have a problem with that. And then in the book there is some concrete proposal of what to do. Talk about price caps on import prices, tariffs, etc. I'll let you read, for example, a chapter by Martin and Veder Di Mauro on that. Then we also look at the impact on the world trade and supply chains. What you see is that Russia has a very important role actually in the supply chains. They're at the top. They're producing many of the raw materials that are then used for other goods. So what happens is that that makes the whole thing very challenging in terms of supply chains as well. We have a few chapters by Michela Ruta and co-authors pointing out that, well, there is quite some resilience of supply chains, but it's important that we show some solidarity. So if rich European countries are now hoarding food, and Egypt and other very needy countries in terms of food imports don't get enough food, then kind of this would magnify the negative effect of supply chain disruption. So Ruta is basically saying, well, the disruptions are kind of manageable if we don't put in place very radical policies that would actually make the impact worse. So where the kind of medication would be worse than the disease. And then we also find, a chapter also finds that supply chain changes persist. So if supply chains go away from some countries, well, they may not return later on. Then in the book we also dedicate quite a bit of space on developing countries, because they're hit very hard, many of them. So many African countries, for example, in the Sahel zone, are net importers of food. So Egypt, for example, and many of the countries a bit more south of Egypt are net importers of food, and there are very big fears that there may be food shortages. And so there are some chapters that would focus on that, and there is a real risk of food riots and conflict being triggered by this situation. So we really have to be extremely careful and solidary and help countries in need. In the book we have some estimates by scholars from the World Bank and other institutions on what's the impact on the poor in different countries in the world, and they find that for agriculture and energy importers in developing countries, the real incomes can drop by up to 5 percentage points. So there is a big spillover as well to countries that are a priori geographically not super close to Ukraine, right? Then we look at, of course, also the impact of the war on Ukraine. I mean, they are the ones suffering most, as I stressed in the first slide. It's a huge tragedy, as I was saying, and also economically, forecasts would be about a third of GDP fall and a massive, as I was saying at the very beginning, massive fiscal deficit. One big question is on the schooling. So there's a whole literature on conflict, and actually my background to start with is conflict. So my specialization is on conflict, and what you see if you look at dozens of papers on conflict is that one of the worst medium-run impacts for recovery is the loss of schooling years, because you don't want the lost generation that misses out on education. And so that's why, so there is this risk. One thing that we can do is that, of course, refugees should immediately have access to our schools when they come to France, for example, or Switzerland. And also for the adults, we want to integrate them and so make them kind of even build up human capital rather than deplete. Then in terms of long-run impact on multilateralism and international system, well, there's a search in European identity. So there is, Kai Gehring has written a chapter where he kind of shows that countries, the closer you get geographically to Russia, the bigger the impact within Europe of having a boost in European identity. So that's one thing that actually you see this very strongly in the data. Financial integration goes down a bit, and then we also have estimates of what would happen if we were to end up in a bipolar world where just a club of democracies trade together and a club of non-democracies trade together, with leading to a median loss here of 4% in terms of estimates. Now, do I have another couple of minutes? Or?
3 minutes.
3 minutes, okay. So I can say some things. There is some overlap with what I said, which was in the last session, but I think the topic is kind of important enough so that we can have some overlap. So then at the end of the day, what we kind of, one of the big conclusions we draw in this book is to say, well, you know, the question is, what can we do? I mean, we from, you know, European perspective or perspective of, say, Switzerland like me, or also France, we're not like, you know, we're neither the US nor Ukraine nor Russia. So in some sense, what can we do concretely? And I think we have this massive problem of energy security, as we've seen. You know, we don't know how to get over the winter. We also have this massive problem of fossil fuels in general, beyond this current war. In general, when you look at the history of civil wars and interstate wars in the last 50 years, a big factor, maybe the most important factor in wars is petrostates and fossil fuels. So basically, if we want to create a peaceful world, there's only one way to get rid of these fossil fuels and move to greener forms of energy. And so here we kind of, you know, look at 10 concrete measures that we could do. So one is one thing is, the first point is kind of important in the sense that you have many countries that now subsidize fuel prices for consumers in order to cushion a bit the hit that consumers get by the higher fuel prices. The problem with this is that, well, in the price there is a signal, right? And so what we advocate here is that if poor households in France cannot manage to pay the electricity and gas bill, rather than kind of putting artificially low prices for gas and electricity and sending the money to either companies or Moscow or somewhere else, what we should do is we should keep the prices as they are in the market, but we should give directed transfers. So we should give them an envelope, and the money they can spend either on energy or on something else. And so in that sense, people have incentives to those who kind of save on energy, they get rewarded, while others less. Then well, there are plenty of other measures that we have on envelope isolation, making business meetings greener, train, solar energy, etc. But maybe I stop here in the interest of time. Yeah, and I move on to.
Thank you, Dominic. Moritz, please.
Does this work?
Yeah.
Great. Well, thanks so much for having me. It's a great pleasure to be here. Thanks for the invitation, and thanks, Dominic. This is actually nicely complementary to what I have to say. I want to talk about the global economic consequences of the war, and I think it's quite clear where they mainly lie. They're in the space of energy. This is not to ignore the Ukrainian suffering, and we've heard also from Dominic what we know from the conflict literature, what should and should not be done, what the priorities should be. I think like cleaning up mines and all of these things are really important for medium-term development after the conflict. But from a global perspective, it's clear that we're talking mainly about energy, effects, and here, I think if we're honest, we're also talking about essentially about the effect of one specific type of fossil fuel, namely gas, on one specific market, which is Europe, which has to do with the fact that gas is shipped through pipelines, and these pipelines cannot be built very quickly and replaced very quickly. Of course, there's LNG, but that's a story where Europe will then have to face the consequence. So let me maybe address my or tell you my key points by looking back at the big debate that we've had in Germany over the past 6 or 7 months. Namely, it was actually triggered by a study that we did with a few co-authors back in March. It was called "What If." What if happens if there's no more Russian gas for the German economy? And then Ben and others have done a similar piece for the French Council of Economic Advisors, and there's now what ifs for France and what ifs for many other countries. And the debate was quite heated at times, and at least in the German economic sphere. The upshot was that there were these sort of, these economists, and I was one of them, who said the effects are actually not as bad as you think they are. Because what we argued is that if you look at the possibilities to substitute gas, even in the short run, for other types of energy, if you pay attention to the possibility of importing gas indirectly through importing gas, energy-intensive products from other parts of the world. And if you, maybe that's a big if, but if you get the monetary and fiscal response to the income shock and the inflation shock right, then you can keep these economic effects. It will still hurt. But the question in March was very much, is this going to be the next Great Depression? Is this going to be the next COVID? Is this going to be the next global financial crisis? Or is this going to be a severe, costly recession, but something that we are actually equipped to deal with? And we were, said in February, we can do this, very much to the disliking of our government. That was very... call it kind of a little bit timid in terms of its overall response to that war, partly driven by the fears that the economic consequences would not be manageable. I think we're now at a position in Germany, which is probably the main country in terms of energy dependence from Russia, where these questions really come to the fore, where there's a consensus that we can do it, that Germany will get through the winter without Russian gas. There might be a technical recession, although the recent indicators are very much pointing towards a mild recession. There is still, it's uncertainty about how cold the winter is going to be, and all these things will play in. But overall, I think the scenario that we sketched out in March has more or less come true. The timid response of the federal government to that war was, looking back, was unnecessary, and it was chiefly informed, and I'm going to come back to this in just 1 minute, by a political economy constellation. I'm looking at Dominic, who's one of the big guys out there in Europe working on these topics, where the corporatist reflexes of Germany, and I think parts of Europe, meaning the tight sort of cooperation between big business and the trade unions, especially in the industrial sectors, that united front that the industry associations and the trade unions put up against the policies and politics in European capitals, basically making the point that this is devastating and we can't do this, was a major headwind in these debates, but also to, I would say, a more informed and more intelligent policy. So that's the short term. So we're going to get through the winter. If the predictions of the head of the German Federal Energy or Gas Agency are correct, we'll even come out of the winter with the storage levels around 50 to 60% full, which then means that also the next winter, given that all these substitution questions what you want is time, and then there's going to be another year, and the storage likely is not going to be empty coming out of the winter. So in all likelihood, the next winter is also going to be okay. When I say okay, this is not going to be pleasant. This is not going to be, savings are real. Savings need to happen. Households need to adjust. The country, and this is one of the big effects of this war, energy importers like Germany, like Europe as a whole, have become poorer. The terms of trade have turned against us. Others have become richer, and we need to adapt to that permanent income loss. But, because I listened to the previous panel and it was mentioned a couple of times as well, don't mistake current gas prices in Europe. I mean, by the way, we agree that oil is not the issue. No, I mean, oil is really a global market. The prices are not even high by comparison, and the oil markets are fine. So it's really gas, and gas localized in Europe because of the dependence on the Russian pipeline network. But the prices that we're paying now for gas are not going to be the medium-term prices. So all of these quite alarmist statements, and I really, having lived through the past 6 months and having seen what industry lobbyists and the economists do to public debate if they have a strong financial interest, all these alarmist points about the deindustrialization of Europe, the end of the German industrial model, I think are very overblown. The medium-term price of gas is going to be higher than it was before. But it's not going to be as cheap, so it's going to be a shock for energy-dependent industries, especially the chemical industry, which is about 3% of German GDP. So you want to scale all your fears for the future of industry in Europe and the German economy by the fact that the most effective industry, which is the chemicals industry, represents 3% of German GDP. A lot of that, by the way, is high value added, just as the Swiss guys, companies have moved up the value chain. We're not producing, the fact that BASF is still producing fertilizer in Ludwigshafen probably tells you that there is a need to modernize the German chemical industry. So we're going to move up the value chain, and we're going to deal with that. There is other industries like the glass industry, which is about 0.1% of German GDP that has a problem, etc. But these things are manageable, and as I said, we don't know what the new equilibrium price for gas in Europe is going to be. It's going to be higher, but it's not going to be what it is now. So it's going to be somewhere in the middle when the LNG terminals come up and running. And so I think these claims are also severely overblown. Let me use my last minute to talk about the other effect that all of this has, namely the effect on inflation, which puts central banks adds to their problems. If you recall, we came out of COVID rediscovering the potency of fiscal stabilization policies. We've done extremely well using fiscal tools. If you compare this to the decade after the global financial crisis, where we've pushed on every monetary gas pedal we had without achieving very much, except for buying up large quantities of assets and flooding financial markets with liquidity, the fiscal stabilization during COVID was extremely successful. It was very, it stabilized the economies. It meant that we got through the shock, and then we came out of this shock with a lot of sort of savings of households in the back. Everyone wanted to use these savings and go on holidays and do nice things at the same time. Structural shifts in the labor market meant we couldn't allocate resources to these sectors that were so in demand now, so we got inflation. Arguably, that's what I'm telling you here is more American story than a European story. American inflation is homemade, it's demand-driven. European inflation is still mostly cost-push-driven. This being said, it's undeniable that in some of the services now you see, the cost push from energy is going into other parts of the economy, and it makes life hard for central banks, right? Because at one time, I just told you on the first part, we have a contractionary shock in Europe. We've become poorer, and high gas prices, and also high electricity prices as a consequence of that are restraining economic activity. But at the same time, you have inflation, and you want to deal with this, and you want to make sure that the inflation expectations don't get unanchored. So central banks are between a rock and a hard place. If I can give you, Marc, I'm looking at time, so I have a couple of minutes. If I can give you my slightly sort of maybe not consensual position here. Maybe I think I've given you a more or less consensual position on the effects of the Russian energy embargo de facto now on the German industry. The only people who I think right now who have a slightly different view typically have an interest to have a different view. On the inflation side, I think reasonable people can disagree what the right course for Europe is right now. The one school is you want to make sure that at any cost almost you come back to the inflation target of 2% in a year or so, a year or two from now, meaning much tighter policies, continued pace of rate hikes going forward. There is a second school, and those people are typically worried about the second round effects and want to make sure that there's not even a chance that we get these second round effects. Then there is a second school that is, and I would think reasonable people can disagree, which says like it's still Europe has mainly a cost push problem. If you look at gas market forwards, if you look at the scenario that I've just pitched to you, that Germany as the largest economy will come out of the winter with storage levels still around 60%. Then there is, I think, only one way forward for gas prices, namely they're going to go down because we have more substitution, we have more time. The winter 23-24 will also be manageable. And more supplies coming online from LNG and other sources. That means gas prices are going to potentially fall quite sharply next year as we clear the winter and as it becomes clear that things are not as tight as many people feared, which then means that European inflation will also come down quite a lot. There is also, so far, very little signs of a wage price spiral. On the contrary, the recent German industrial wage settlements have been very reasonable. They have claimed, which is, this is, just urge you don't get, like if you see 8% or high numbers like that, that doesn't mean anything. That means that backward-looking unions are asking for compensation, which is fair because the companies have raised their prices by 8%. So this is a distributional question between capital and labor, backward-looking. That has nothing to do with the wage price spiral. A wage price spiral starts when people expect higher inflation going forward and ask for compensation ex ante today. And of that, there is zero sign in Europe right now. We're all looking backward and saying, like, oh, we have to deal with this 10% increase in prices, and what's the share that employers pay, and what's the share that is a real wage loss for employees. But we're very far away. So I think just as the Fed, the ECB will be a little bit late to the game as usual, but over the coming weeks, it will become clearer that rates will also not rise as much in Europe as we might have thought a few weeks ago. Okay, thank you very much.
Thank you, Moritz. So next, Tomas, please. Yes, Bocek.
Yeah, okay, good. Hello, still good morning, I hope. So I will start with the obvious, and something that was mentioned by Dominic, that Ukraine needs our help. And I will try to answer the question, what can we do from a perspective of development bank with a rather special mandate. So we are all aware that of the need for massive support to Ukraine in the short, medium, and long term. And in this context, I would like to comment, and I hope that Alexander is listening to me, that I would like to commend the Ukrainian authorities for their capacity to produce very substantive assessment of needs and of priorities, while operating under enormous pressure. This is the first thing. And the second is for the effective collaboration with IFIs and with the other international partners. So you all know that the debate on how to best organize the support to Ukraine and ensure coordination among all the involved actors is ongoing. There are many political considerations, sensitivities around this discussion, but what is paramount is really that it is moved forward quickly, as needs on the ground are very pressing, and also the support must be predictable. Another very important element that's been discussed now concerns the nature of the support. And what do I mean by that? Grants or loans. It is clear that many of the needs would require grants from partners. At the same time, it's equally clear that the availability of the grants is limited. So hence, the ability to provide loans at the best possible conditions is also crucial. In this context, of course, many have a role to play both at the bilateral and multilateral level, and certainly MDBs are key actors, and yeah, both of us are representing these institutions here. And these MDBs, I mean, includes those that were present in Ukraine before the war started, but also those that are about to start to operate in Ukraine soon. So where were the CEBs in all of this? As oldest multilateral financial institution in Europe, the only one having a unique mandate, unique social mandate, with the mission to promote social cohesion, and the CEB does it by financing social projects that serve vulnerable people. We are active in health, education, social housing, and we have been helping support refugees, internally displaced persons, migrants, and host communities since our establishment in the aftermath of the Second World War. But with Ukraine is a different story. Why? Because Ukraine is not our member state yet. So, so far, that's why so far we have, our action has been concentrated on supporting refugees fleeing Ukraine. Since 24th February 2022, we approved 1.3 billion in fast-track emergency loans. And this is equivalent to nearly 1/3 of the bank's lending volume for the year. We have also provided small targeted emergency grants for really humanitarian assistance of the most vulnerable refugees from Ukraine. And here we have cooperated closely with the IOM, leveraging their strong presence in the field. So you may say the CEB's firepower is rather limited compared to our to other IFIs, to our peers, but the impact is rather large, because in the Ukraine crisis, over 2 million refugees are expected to receive aid thanks to the CEB funding, loans and grants combined. So now the situation is about to change, hopefully, because Ukraine a few months ago asked to become a member of the CEB. So now the membership is the membership process is well advanced, and it should be completed by the end of 22 or in early 23. What this means? This means that it will allow the CEB to operate in the country. What we are planning to do? Well, first, our action will be guided by the priorities of the Ukrainian authorities and will be selective, so as to intervene in areas where we can really provide an added value. Leveraging our existing experience in post-conflict settings, we will focus on investing in social infrastructure and the provision of essential services for vulnerable groups and displaced persons. So what concretely? Housing is said to be one of the most daunting challenges facing Ukraine in the coming years. And we think we are really well placed here to help. The need for high quality and long-term housing solutions is projected to be immense in the reconstruction phases. This will entail rehabilitation and upgrade of the existing housing stock, as well as the construction of new housing, including social rental housing, and related infrastructure. Just for your information from the data we got in October, there's 123,000 individual houses damaged and 16,000 multi-apartment buildings damaged. The damage is worth of 50 billion euros. So this is the first area. The second, beyond housing, investing in Ukraine's human capital will be key. A healthy, educated, productive population is a key pillar of sustainable, inclusive, smart growth. And in this respect, Ukraine will have to rebuild and rehabilitate the essential social infrastructure underpinning the provision of services that are instrumental for human development. And in particular, education and health emerge as key sectors where, again, we can have added value. Just to give you a flavor how important the support for Ukraine will be in our future work, let me tell you that the support to Ukraine is one of the 3 overarching objectives of the new 5-year strategic framework of the bank that we expect and we hope that our shareholders will approve this week. But in fact, all 3 objectives are linked to Ukraine, because the second one is investing in the assistance and integration of refugees as migrants in their host communities and in preparedness for future migratory dynamics. And finally, the third, as well, because this objective is to remain flexible to respond to evolving social development, to address the rising social needs in our other member countries. We must not forget that the war and the uncertainty, as we have heard, surrounding its evolution are also generating adverse spillovers outside of Ukraine, putting the fragile recovery of 2021 in jeopardy. And we have heard also several times today that economy is in fire. But the crisis is disproportionately affecting poor and vulnerable people everywhere. High energy and food prices are placing a heavy strain on lower income families. Access to high quality, affordable health and education remains uneven. Social and affordable housing needs are rising rapidly across Europe, and a large share of the existing social housing stock does not meet quality and energy efficiency standards. So overall, in these extraordinary times, and I'm going to finish with that, our mandate is more relevant than ever, and we are committed to delivering on it. We will continue to work with our partners. We will deploy our experience and resources to help rebuild Ukraine and to support all vulnerable groups affected by the war and its impact. And I will finish here. Thank you.
Thank you. Carlos, please.
Thank you very much. Marc, thank you very much for the invitation for EBRD to intervene today here on such a relevant topic for us as it's the situation in Ukraine. In my presentation, I will just very briefly cover 3 elements. One is to go briefly through an explanation of what we're currently doing in Ukraine, because we are very active already this year in Ukraine, and I can anticipate that we're active already in reconstruction, so it's not just about resilience, but we're already there in terms of early stages of reconstruction. Second, how coordination is working so far and the role we are playing, also with our colleagues from the Council of Europe Development Bank and others, and what we think should be done to improve cooperation going forward. And third, just very briefly, some ideas on the direct impact we're seeing in some other countries as a result of the war in Ukraine. So let's start with what we're doing now in Ukraine. I mean, the bank, the EBRD, has been very active in Ukraine for many years, since the beginning. We're probably the largest international financial institution in Ukraine. We have invested over the course of 30 years in more than 500 projects. We have invested roughly 20 billion euros. And we were, before the war, we were investing on a regular basis 1 billion euro per year in Ukraine. we used to have a team of staff of 120 people in the country in 4 different locations, and now all of them are working from Warsaw. And I have to say that they are working very closely in close contact with the authorities, in line with what has been mentioned before. It is really amazing the capacity of the authorities to be so reactive in these difficult times, but also with the private sector. So the private sector institutions are in close contact with our colleagues and trying to see how we can all help them going through this very difficult environment. I'm going to be talking a lot about private sector because this is the focus for EBRD. So we complement what other institutions are doing on different fronts, mostly budget support. But in our case, the focus is private sector, and state-owned enterprises is also another area where we have been increasingly involved in these days, in these months, in Ukraine. And what are we doing now? So we have gone from investing €1 billion per year in Ukraine to invest 1.5 billion euro this year. So quite a remarkable evolution. Ukraine used to be 10% of our total investment. This year is going to be probably closer to 15% of our investment. But there has been a change in the way we engage with the private sector and state-owned enterprises in Ukraine over the course of this year because of the high risk of the investment in a country at war. So we have stepped up our investment, but we have asked our shareholders for additional support to limit the net exposure, the net increase in our exposure in Ukraine. So the 1.5 billion euro we're investing this year is on the basis of a 50-50% share of risk. So on average, shareholders are contributing to 50% of the risk. This has been done, of course, on a voluntary basis. So there has been some pledges some commitments from the different shareholders. Once the scheme was designed, and there has been a very significant support from all donors, from US initially committed 500 million euros in support of our operations in Ukraine, but also the European Commission, the European countries, UK, France, Germany, Denmark, Germany, Spain, Netherlands, Canada. I mean, there's been Norway. There's been a very quick and impressive, I would say, reaction. So we have managed already to receive the commitments for 1.3 billion euros in guarantees that will help us guarantee 50% of our investment this year, and has allowed us to already commit roughly 1.5 billion euro investment already for 2023 on these same patterns, with the same pattern of 50-50 support from donors. So here, the main point is that there's need of a clear alignment and combination of the activity of financial institutions, in our case IFIs, with a grant support to ensure the necessary level of concessionality, and we have seen this response so far. And the change in the share of risk is not the only one that has that I would like to highlight in terms of our engagement in Ukraine these days. It is also different because we used to invest mostly private sector, 75%, and for productive investment. Now we have had to adapt to the new reality. So SOEs are increasing their share in total investment, and liquidity needs is also a big thing in our investment policy. We started as early as March, May, before summer, engaging with particularly the private sector in terms of resilience, with liquidity provision, as I said, on key sectors, in close coordination with the Ukrainian authorities. So that was agribusiness, that was pharmaceutical, that was transport and logistics. And also state-owned enterprises dealing with a vital infrastructure, which is essential for preserving economic activities such as railway, gas, and electricity. and as the war has been evolving, and as I said before, Marc, we are already engaging in reconstruction, because that's what we think is necessary at this point in time, particularly after the more recent change in the strategy by Russia attacking civil infrastructure. So we need to respond, and we are working very closely with the Ukrainian authorities and the Ukrainian SOEs to identify where the needs are, to replace as quickly as possible the necessary equipment on railway, on electricity grid, and then also gas provision. So this is at the core of what we're doing these days, with big support from our shareholders and clear alignment of all the board in support of what is needed from Ukraine. Let me move into the second issue, which is, as I mentioned, we are already in the reconstruction phase. It's early stages of reconstruction phase, one driven by the needs for urgent repairs, but we're already there. So coordination is increasingly more important. We have seen coordination stepping up, but there's still some way to go. Since the beginning, since the end of February, beginning of March, some of the IFIs involved directly in Ukraine, or indirectly dealing with refugees, as is the case of the CEB. We've been getting together every 2 weeks. So this implies EBRD and CEB, but also the World Bank, the IMF, the EIB, and the European Commission. So every 2 weeks we were getting together and exchanging views on what we were doing, and what was basically the projects were. At that time, for instance, where we needed to pool resources to reach the very big needs we were identifying, for instance, in terms of gas provision from Naftogaz. This coordination has been evolving and has recently seen two significant improvements. One of them is that Ukrainian authorities, US authorities, we're trying to get also G7 involved in the discussions. Second is because we're not just exchanging views, we're trying to identify potential solutions to problems that we have to tackle all together. For instance, how to repair the electricity grid in the country. And here we're getting direct information from the Ukrainian authorities on what the needs are, and we're trying to respond with what each of us can do. And as you know, all of us, Marc, we have some sort of a complementarity in terms of our mandate. It is different, clearly the one that has been mentioned for CEB from the one we have for private sector, but also World Bank and EIB, for instance, are better suited for large tickets for budget support. This is not what we can do. We are better suited for smaller tickets for private sector. And then in SOEs, we try to work together and see how we can all complement each other. But as mentioned before, this is still a bit of an informal way of organizing the coordination. If you think about what's going to be necessary in years to come, there's need of a clearly designed reconstruction plan, and quite an ambitious one. And here we need probably a better organized coordination. From Lugano, then to Berlin, the conference. We've been trying to make the way, but it's we're still not there. We need to be more clear on who's taking part in this platform, to do what, and how the funds are going to be used to make sure that there's full transparency and accountability, but also respond to what are the needs of Ukraine in terms of the use of the funds, and also clearly align them with the accession process towards the EU. Let me just go briefly to the four things I wanted to mention in terms of other consequences we have seen very directly already this year in other of our countries of operations. So I wanted to stress four different situations. One is Moldova, which is a country where we are seeing basically a situation very comparable to the one we're seeing in the eastern part of Ukraine in terms of the impact that the war is having and the need to step up the vital infrastructure. And in our case, from EBRD, we're going to see a record year in terms of investment this year in Moldova by multiples from what we used to do in the past. Second is Eastern European countries, where we are seeing a completely change in the pattern. In I don't know, Poland, Hungary, Czech Republic are countries where EBRD was less and less necessary. Even there was a consideration of the possibility of these countries graduating and not making use of our funds any longer. In the current environment with tighter financial conditions, it is just the opposite. So we are also increasing our investment in Eastern European countries. More distantly, Northern Africa, we are also seeing bigger needs there, particularly in relation to food security. So we are increasing our investment in Tunisia, for instance, or Egypt because of that. And last, an evolution that is a bit counterintuitive. At least it has come a little bit different from what we expected, which is Central Asia. In those countries, we thought that our activity, because of the traditional close links with Russia, was going to go down, and it has been just the opposite. So we have seen that Uzbekistan, Kazakhstan are really looking for some alternative ways to counterbalance the influence of Russia, and we're going to have again, for instance, in the case of Uzbekistan, a record year in terms of investment this year, and quite linked to also the energy security and the possibility of helping finding new sources for energy. So that will be it from my side, and just to clear conclusions on one point is the importance of keeping the support to the real economy in Ukraine. So budget support is fundamental, macro stability fundamental for the country, but keeping the economy up and running is also essential, and also the fact that reconstruction is already happening now, and we have to step up the coordination procedures for delivering. Thank you, Marc.
Thank you. So let me ask now, we have Alexander online, or? Yeah, so Alexander. So Alexander Rodnyansky is the advisor of Mr. Zelensky on economic affairs, and he told us that...
That's right.
Yes, Alexander, welcome, yes.
Thank you. Well, as you can see, the format is a bit unusual, but that's what we have when there's no electricity and barely any reception. So let me try to proceed. Thanks very much for bringing me on. It's a pleasure to take part in this conference. I will just briefly outline, what our thinking is and what the process is right now and the state of affairs when it comes to thinking about reconstruction and recovery. So broadly speaking, there's two parts for us. One is the institutional design. And recently we had a conference that was the major conference so far on the whole recovery, reconstruction, and modernization agenda in Berlin, hosted by Chancellor Scholz and von der Leyen. So I was the co-organizer. We were there for one day to talk about exactly those issues. So the institutional design, the framework, the types of mechanisms that will have to be established going forward to guide and regulate the donor-recipient mechanism, the type of support that we'll be receiving, and also some of the more detailed questions about industrial and development policy, how it should be structured, and the way we should think about it going forward. So we're still in the process of politically deciding these issues and setting up the institutional infrastructure and design. And so that's going to probably continue for some time, but the consensus view seems to be that we need one window of coordination where essentially internally we will have one institution that will coordinate the donor recipient agenda and make sure that we have the trust and the support that we can possibly get from our international partners, along with all the donors themselves having representatives that will then help coordinate this process from every respective country. So in all likelihood, there was different models that were proposed. One model was to have a fund. Another model was to have an agency along the lines of what happened, for example, in Indonesia after the 2004 tsunami, which is seen as a success story. But another model that would probably fit in better into our constitutional framework is to essentially have a ministry for the reconstruction and development that will then essentially take over these roles and guide the process. So that's the institutional setup, and that's one part that will have to be designed very carefully so that we are in agreement with all of our international partners. And the other part, of course, is the actual implementation. So a lot has been already said today, I think, in the discussion so far about the short-term implementation and the medium and long-term priorities that will have to be then taken care of as we sort of move along. I will just outline briefly. So our thinking right now is primarily about the short term because we are in a wartime economy, and wartime economic management differs quite substantially from normal economic management. And so one key difference, if there's one key difference that I would point out in this short statement, and I would say that in a wartime economy, weapons and defense plays a very special role. It's not just about the war itself and making sure that we recapture our lost territories or territories that are currently under occupation, but it's the best and most efficient and most important form of economic stimulus because, you know, we have the perfect illustration in recent weeks when, you know, we were exposed to this series of attacks through air bombardments and cruise missiles. And if we had the necessary air defense systems in place already, we would be able to protect our energy infrastructure, we would be able to continue exporting electricity to the EU, and we would probably face a contraction of our GDP that's much less than what we're currently going to face. So the estimates before the recent attacks starting in October were that our GDP was going to contract by around 35%. Now, after these attacks, the recent estimates say that it's going to contract by more than 40%. So that's just, 5% at least added on. And there's probably more to come. So that just shows you very clearly, how much this actually costs in terms of GDP, in terms of economic activity. And so I'll just repeat that weapons and air defense systems in particular are the best form of economic stimulus that we can have in a wartime economy. And it's not just this mechanism that I described, which is very clear and goes through the energy infrastructure, but it's also about reducing uncertainty, because now we're in this period of proliferation of uncertainty where essentially any individual, any entrepreneur, any firm, when they see how exposed we are to all sorts of attacks from the Russian side, really doesn't have any incentive whatsoever to plan for the future, increase employment, or even spell out the types of investments they'd be interested in. So I will say in the short term, that's priority number one. And that will also mean I will also say this is the least costly way of supporting our economy in the short run, because we've spoken a lot and we continue to speak about budgetary support, and that's very important. Obviously, we need balance of payment support, macro-financial support, but we will need much less if our GDP is not going to contract by as much. So it's also less costly to provide these weapons in order to then have less macroeconomic support that we would have to receive from the EU and from the US for our functioning of our economy, just in the regular function. So that's what I will say, and that's what we're focused on primarily. And then moving on to the medium to long run, this is where the infrastructure and the institutional design that I mentioned at the beginning will become paramount. That's where a lot of the discussion from the previous speakers is also important. That's when all these things will come together, when we will need to plan the modernization of our country and make sure that we build back better according to the state-of-the-art techniques and technological advancements that we can possibly implement. So it will mean that we need an infrastructural program, hopefully driven by the private sector at that point, with the government just playing, sort of a key role in oversight through these institutions that we'll have set up, and also reforms. So a lot of the recovery and reconstruction effort through reforms. And this again is key to coordinate with our partners as part of the general EU integration strategy that we're on now, and we're certainly looking forward to that, to that part of the recovery. But I would just say that we are very far off at this point, because we're still in the middle of the war, and it's unclear, what sort of escalation we're still up against at this point. But I will just conclude with that. Thank you for bringing me on, and hopefully we can perhaps move on to the questions at some point. Thank you.
Thank you, Alexander. Yes, let's take one or two questions because we know we are running late and we are trying to catch up with the time. So anyone from the panel or anyone from the floor? Yeah, over there, in the, please.
Thank you, panel, and thank you, Alexander, for your very succinct summary of the situation Ukraine's in. I have a question for panel and Alexander. I've been working with people in Chernihiv since the start of the war. I'm actually going to go out there myself. And we're working at a hybrid support system where soft issues such as mental health and support to post-traumatic stress and community stress is combined with rebuilding and construction using a mixture of NGOs, but also people from the commercial sector. And we've took that initiative ourselves to deliver that as a template to then build out from there. I wondered how that would fit in both with the, and what I'm actually hearing is the amazing work that's been done by the government of Ukraine, but the slow pace of response of the money trickling down to grassroots projects. So I'd be interested if the panel could speak to that particular situation.
Let me see first if there is one last question from the audience. Okay, let's... you want to take... please.
No, I was actually telling Thomas that maybe it was more if we were talking about investment on health. That's something that the CB does better than what we do. So that's from the EBRD. That's something that has not been discussed before. We are of course always open for engaging in potential new ways to support Ukraine and its people. But for instance, housing or health are fields where it is less suited for us to invest. So for the time being, nothing has been done on this front, but we are of course open for potential exchange in the future.
Thank you. Yeah.
As I said, we are starting slowly now to build cooperation with Ukraine, and health sector is obviously one of the ones that we are willing to cooperate, but maybe not to delay the debate. We can talk bilaterally afterwards, right?
Thank you. Okay, so let me first maybe close the panel. I want to thank all the panelists and particularly Alexander for joining us during this very difficult moment for you. And we look forward to welcome you hopefully next year in time of peace in Paris. Thank you. See you.
Thank you.
Okay, lunch is served outside, so please you can go there and we will reconvene for the next session in the afternoon, I think around 2:15. Thank you.
I have to run, I have a department meeting, but I'll get some